Are things bad enough here to have a lot of innovation? So, this morning I was walking down the street in Boston and I decided to be like, those guys on Candid Camera? And I started asking people, well, how often do you think we have a financial crisis? And some people said, well, I think it's about once every 5 years. And some people said, well, no, I think it's about once every 10 years. So I'm going to ask the audience here, and we got to have a little fun here. So let's take a vote. How frequently do we have a financial crisis somewhere in the world? So how many people are going to vote for 5 years, once every 5 years? How many people vote for once every 10 years? How many vote for once every 20 years? How many vote for once a year? Okay, well, let's see what the data says here. Can we get the slide, sir? Okay, so here's some data. On the left-hand side is Professor Eichengreen from Berkeley, and he has a very broad definition of financial crisis, and he includes banking crisis, liquidity crisis. He also includes, importantly, defaults and sovereign debt. And if you look at his numbers, you have more than one a year. And the important thing is you can see they're accelerating. And so after the quote-unquote bad years in the 70s, we had even more financial crisis. Now on the right side is Ken Rogoff, who teaches with me at Harvard. And he has a really nice book, and he has lots of different definitions. But his narrowest definition is you have to have a major banking crisis in which the government puts capital into a bank, and it has to happen in an advanced industrial society. So it's a fairly narrow definition, but he gets 22. And here's the kicker. All those 22 occurred after 1977. So we can see we've had an accelerating financial crisis. You may say, well, maybe that's because of globalization, et cetera. So what I'd like to do tonight is talk about what we could do to reduce the frequency of financial crisis. And I'll talk a little about the macroeconomic picture and some investment themes that grow out of that. And then I'm going to talk a little about some regulatory themes, both within the United States and internationally. So let's begin with this. This is the U.S. current account deficit. Why do I start here? In many ways, the financial crisis grows out of this chart. The U.S. imported so much, and there were so many dollars left in China, Japan, India, the Middle East, that these dollars were what we call in the investment business very yield hungry. And when Mr. Greenspan, despite what he says, held interest rates very low from 2001 to 2006, people couldn't go into treasuries and get the sort of yield they wanted. So that's what really drove the demand for asset-backed securities, which got Wall Street to generate them, got brokers to do subprime loans, et cetera. So you mentioned imbalance, and this is really the question, is we have a tremendous imbalance now between in these current account deficits. And if we still have lots of this money sloshing around, it actually has a lot of potential for danger. So let's think about what we could do and look at both sides of this. So let's look at the China side, because China is the country that has the biggest surplus. It's the country that now is the biggest exporter. Now here's the unusual thing about this chart. China didn't have a financial crisis. China is pretty closed from, it doesn't have a convertible currency. Yet China had, as a percentage of GDP, the highest stimulus package in the world, higher than the US, higher than Europe. So what do we see? Those of you who go to China now, we are on the verge of a bubble in China, in real estate, to some degree, in other businesses. And because China has locked itself into the US currency, it really isn't able to cut off this potential bubble by bringing up higher interest rates. You see the central bank there trying to do a lot of different things. And the key question is, I think, one of the key questions is, Can China turn itself from the world's biggest exporter to something that builds up some internal demand for consumption? Because, quite frankly, I don't think the rest of the world can handle China's growth as an exporter just to continue and continue. It has to itself, to rectify this imbalance, start internal demand. And to my mind, and I've spent some time in China, my book now is translated into Mandarin. I'm sure many of you read it. And, but they changed the title. They had to have a Maoist saying. I've learned now that there's a Maoist saying for almost everything. So my book has a Maoist saying, says, big problems need big solutions. Anyway, but the key is, I believe, that it's the social structure of China. Now, some people say Chinese people are born savers. You know, it's like they come out of the womb and they have a little piggy bank on their, waist. But it's not true. People used to say that about Japan. The personal savings rate in Japan is now down to 3%. Why do people save so much in China? And they do save a lot, like 25% of their income. It's because they have such a weak social net, terrible medical insurance, and a very weak retirement system. If you were making $4,000 a year and you knew if you had to go to the hospital and have an operation that would cost you $2,000 out of pocket, you would be a good saver too. And retirement. Now China has this one baby, one family, so they're not going to have their children to support them in old age, and the retirement system in China really needs a lot of work. The good news is China knows this, and they're trying to improve it, but in my view, there's lots of opportunity in retirement, lots of opportunity in medical care in China, but until that happens, this imbalance can't change. Now, let's look at the US side. The US side, now here I'm going to use a pointer if I can do it. So here the personal savings rate in the US actually was negative in 2006. It is not easy for a country to have a negative savings rate. You really have to work at it. But we managed to do it. We spent so much money that we spent 130% of our actual income. Now, because of the recession, we finally have a personal saving rate that's positive, about 5%, that's about 500 billion. But here's the problem. Look at this. Last year, October of 2009, the deficit was 1.4 trillion. What is it going to be this year? About 1.5 trillion. A trillion here, a trillion there. It starts to mount up, even in Washington. These numbers are so high. Think about this. Since World War II, before the second highest year was 1983, and that was 6% of GDP. We're now at 10 or 11% of GDP. We are at twice the level of deficit of any American government since World War II. Why is that important to all of you? Interest rates. Right now, we're in nirvana. There's no inflation, there's no interest rates. But if US keeps doing this, we are going to find the interest rate on treasuries and everything else going up. People would say, well, Japan has a high debt, but in Japan, 95% of their treasury debt is held by Japanese. It's a revolving circle with the postal savings. In the US now, about half of our debt is held abroad. And when I was in China, I gave a speech, and this is the way I began the speech, by trying to tell a joke. And everyone laughed. And my desire to be a stand-up comedian was fulfilled. But then afterwards, a friend of mine came to me and he said, "You know how they translated your joke?" And I said, "No." And he said, "The translator said, the American has just told the joke." Please laugh. Now, I tell you this because Tim Geithner, the US Treasury Secretary, he came the next week. And he gave a speech. And at the end of the speech, somebody stood up and they said, "Mr. Treasury Secretary, we now own in China 900 billion in US Treasuries. How should we feel about that?" Mr. Geithner responded, he said, "You should feel very good. Your money is safe with the US Treasury." And you know what happened? The crowd broke up in spontaneous laughter. And he didn't even think he was telling a joke. So, if the U.S. does not control its spending, really, it will be a serious problem. And we'll go quickly. The next thing is the only good thing the U.S. dollar has going for it now is the euro. As Einstein said, everything is relative. And at some point in the euro, they'll figure it out. So we're bailing out the euro, mainly because all of these euro banks own these bonds. So we shouldn't feel so good about the dollar. You know, as one friend of mine said, the dollar is less ugly than the euro or the yen. It's not exactly a strong argument for it. So let's go and talk a little about what are the implications. Now, this part is a conglomeration of surveys that I've looked at from all institutional investors as venture capitalists. I know you all want to get funded. So what are these people doing? So one thing they're doing is they're going to allocate more money toward fixed income. Now, this is actually very understandable because they've all gone through the crisis. They feel, well, we need more liquidity. We don't want so much volatility. But in my view, this over a period of 3 to 5 years is actually suicidal. It's suicidal because interest rates can't go any lower than they are now. So what's going to happen here is, here are where bond yields are. You don't have to be, a mathematician to figure out that we're at all-time lows. When interest rates go up, bonds go down, and so I think there's a lot of implicit interest rate being taken by people who think they're going towards safety, but they're actually not. And you will face this too in your funding when you see people who want to be very conservative, and they think they're being very conservative by going to governments, but they actually aren't, because interest rates can't stay this low. I can't tell you. The euro essentially extended this period, but I don't know whether it'll be 2011, 2012, or 13, but interest rates will go up. Now, another thing we see, I personally argue that if people want to go into bonds, they ought to go into emerging market bonds. And this is really one of the great unsung classes. Look at those returns. They've been fantastic, and they're also uncorrelated. They're uncorrelated with stocks, they're uncorrelated with long treasuries. So I'm a big fan of emerging market bonds, and quite frankly, if you look at the balance sheet of some place like Brazil, it looks a hell of a lot better than the balance sheet of the US. And that's what I think. Now, another trend we see is this. Up to quite recently, most equity investors would invest in their home country. They would invest most of their money in home countries. But now I think you see a new move away from home country and toward global equities, international equities. And here's the thing. Some people argue that the financial crisis means that you shouldn't do this. You shouldn't invest globally. And why do they think that? Because for a short period of time, as you can see, September to March, there is what investment people would call convergence. That is, all asset categories went down, and they went down together. Now, that is true. So there was convergence. But here's the interesting thing. If we look at this right side, we can see that already we have decoupling. Already, look at India, India, Brazil, South Africa, Britain, US. You already see huge differences. So my take from this is, yes, if you're a short-term equity investor, convergence can hurt you, but you shouldn't be in equities unless you're prepared to be there for 3, 5, 10 years. And we have, over the long term, significant benefits from diversification. And you can see them here. And again, if we look at emerging market returns and we look at all these other asset categories, we can see that emerging market returns have actually, before the financial crisis and after the financial crisis, even more so, had much higher returns than any other asset category, even higher than treasuries, which have been a safe haven. So you guys are the experts in emerging markets. I say there's a tremendous advantage there. Right now, most institutional investors only have 3 or 4% of their portfolios allocated to emerging markets. It's really underweighted by any way of looking at it. And you guys are in a good position to change that. Now, the other thing is we see continued interest in alternative investments. And by that, I mean hedge funds and private equity, so we're still interested in Blackstone, you'll be glad to know. The question is that rational? Hedge funds and, to some degree, PE said, the promise they said was, we will give you absolute returns, which means we'll give you positive returns in up and down markets. Did hedge funds have positive returns in 2008? No, they didn't. They were down about 18%. But other markets were down 40%. In 2009, other markets were up 40%. Hedge funds were up about 18 or 20%. So what's interesting is that people are still interested in hedge funds. It can't be because they actually deliver on absolute returns. They don't. But hedge funds do have less volatility. They have less volatility on the downside and less volatility on the upside. So I'm now going to move to the next part of this presentation, and that is talk a little about what's happening on the regulatory side in the US and abroad. So this chart is more complicated than I can deal with almost. So now we're going to have a chance for another citizens' participation in this thing. So here's the question. We all know that the US government bailed out Bear Stearns, AIG, and a variety of other institutions. What was the theory? Too big to fail, too interrelated to fail. So the question is, how many institutions? Give me a break. Give me a guess. What is the total number of institutions that the US government, the Treasury, put capital in? What do you think? Give me a number. Yeah. How many, who said a number there? We have 20? 200. Okay, let's go. So, we have 20, 200. It's higher than 200. 2,000, it's too high. 500, it's close. The total number of institutions that the US Treasury put capital in the last 2 years is 670. Now I ask you, is there anyone in this room who thinks that there are 670 institutions in the United States that are too big or too interrelated to fail? Is it possible? It is not possible. So what happened? This is how it began. Hank Paulson. How many people know that Hank Paulson actually wanted to be Marlon Brando? Have you seen the movie Godfather 1? Or God? Well, this is the way it began. There were these 8 people who came into the room, the heads of the 8 biggest banks. Here they were. And Hank Paulson, who thought he was Marlon Brando, said, I have an offer you can't refuse. And he started out giving little piece of paper, 10 billion for you, 20 billion for you, 38. By the time he finished going around the table, 125 billion. Now, Jamie Dimon said to him, you know, Hank, I actually don't need the money. Hank said, I'm sorry, you can't leave this room. You take the money. Then Lloyd Blankfein from Goldman said, you know, our PR isn't the greatest. Maybe it wouldn't be so good for us to take 10 billion. Hank said, no. So what's his theory? Why did he force all these people to take 125 billion? Now we know from his biography that he had a theory of avoiding stigma. His theory was that if the Bank of America or Citigroup walked out with money and JP Morgan and Goldman didn't, then no one would ever buy Citibank or Bank of America. The question is there any support for the theory of stigma? In my view, the answer is clearly no. We know as investors, when the government puts capital institution and it bails it out, and if that institution has more problems, you know what the government does? They give them more money. It's the best investment you can make. And then, this is the really irony. So then all the small banks came in and they said, well, wait a second. We don't even know how to spell derivative. We didn't give these big bonuses. We didn't do anything wrong. And you're giving out all the money to the big guys. So of that 670, there were actually 200 banks that were given money because they were small. So you've heard it here first. Too small to fail. It's a compelling theory. But what should we learn from this? We should learn, and I'm telling you the same thing's happening in Europe and in all other places, is that if you don't get a coherent theory of what actually you're doing, and you decide in advance rather than doing it over a weekend, everybody is going to bail out everybody in sight. And this is what we call moral hazard as economists. That is, all these big institutions can't fail. Now, one of the things people say is we have bailed out these banks because they are critical to the loan volume of the country. So in 2006, if we look at all credit that was given in the United States, what percentage was given by banks? 25%, 50, or 75%? Let's have a vote. How many say 25%? How many say 50%? How many say 75%? It was 25%, because most of credit is done through securitization, and securitization has gone really to the point where there's almost no securitization except if it's subsidized. So one of the things that we need to do is to get securitization going, because for those of you who want loans, that's where loan volume is. And we had in 2006 over $1 trillion of loan securities securitized, and this year we'll probably have about 180 billion, and that's a huge drop-off. So restarting securitization, I'm going to skip this and go to the next. Whoops, screwed that up. Back. So we need to restart securitization. The other thing I can't pass up this is executive comp. So when you give out so much money to so many people, they become very interested in their executive comp. And in my book, I have a whole chapter of what happens when the government gets involved with trying to regulate executive comp. And the summary is unanticipated consequences. In February 2009, Congress passed a law saying if you got federal assistance, your big financial institution, the bonuses of your senior executives cannot exceed 1/3 of your base. So what do you think happened? All the bases went up. Wells Fargo, the CEO in 2008 had a base of 900,000. In 2009, I didn't make this up, he had a base of 5.4 million. Isn't that a tremendous step forward in corporate governance and the control of executive comp? We've turned, it's not a raise, that's what he got the year before in bonuses, but we've turned we've turned a performance-based bonus into a guaranteed salary. Crazy. So I'll just say a few words about international regulation because we're running out of time. And this is a picture of Basel. So one thing people say is if we only had harmonization globally, then regulation, everything would be perfect. So this is actually Basel. And the most important thing to understand about Basel is it's a great place to have lunch or dinner. They really have good food in Basel. And you know why I know this? Because all the bank regulators from around the world came to Basel for 20 years, and they came up with Basel I. And this was adopted by every country. And that's a capital requirement for banks. And this is what it said in short. If you have 100 million of regular loans, you put up 8 million of capital. But if you have 100 million of mortgages, you only put up 4 million of capital. Why? Because mortgages are inherently less risky than any other loan. This international agreement was a major factor in causing the financial crisis. But we now have a new rule called Basel II, and it goes about this high, et cetera. But the new rule says essentially that if you're a large bank, you look at each asset and you run it through your own risk models, and you come up with your own capital requirement. Now, those of you who, I'm sure some of you have seen these risk models of these large banks. Well, I've been in these boardrooms. There's always somebody, he or she usually has a PhD in math from MIT. They come up they show all these equations, they go through this whole thing, and they say, so we have risk covered. There's not a director in the room who understands one thing that that person has said. They have no idea whether it's correct. And another thing you have is like VAR, value at risk. It's a great risk system for measuring the risk of your overnight book within the second standard deviation. So somebody has a new derivative, they come in front of the directors, they say, our total exposure is 30 million. What they really mean is our total exposure between today and tomorrow, if we have a normal distribution curve, is 30 million. If the directors understood that, they would be very scared because they have no idea. So this is what another thing we really need to do, is to get off these internal risk models and actually have risk models that test out scenarios and ones in which directors can understand. Now, one of my great favorites is protectionism. You always have these great statements like this one here, G20, no protectionism. Everybody gets together and says no protectionism. Now, I have to say that within 2 days of that, India raised its tariffs on steel, and Russia raised its tariffs on cars, and the US came up with its Buy American. So everybody pontificates, but when you come to actualities, they all protect their own. And one of the things I think we need to do, because this will affect all of you, is we need to get countries to at least agree not to make things worse in a trade barrier. So they ought to commit that whatever their current barriers are, don't raise them. I mean, it's a modest objective, but I'm telling you, it's very important. And last piece of regulation is from the IMF. Now, I want you to take a close look at this. Look at this. How many people think that Belgium is more important economy than India or Brazil? Anyone? And here's the proposal. Belgium's going to go down to 1.8%, 6%, so it will actually be slightly below India, but below Brazil. I say to you that the world organizations, the World Bank, the IMF, are so out of kilter with the way the world is. They're all living in the past. They're living 20 to 30 years in the past. So I believe, as I've said, that the emerging markets are really important and they need to show this. So let me give the conclusions here. One is, if you're in the midst of a financial bubble, try not to get carried away. When I was president of Fidelity in 1999, all my marketing people said, we need an internet fund. And I said, gee, I can't even understand what are these companies, these internet companies. I don't understand their business model. And they all told me, what'd they say? You don't get it. And I said, I guess you're right. Luckily, my chairman, Ned Johnson, agreed. He didn't get it either. And within 2 years, they thought, well, maybe they didn't get it. But you have to have patience. The key to every bubble is you never know when it's going to end. If you're right logically, you've got to stay with it because it will come to a bad end. Second is, you have the expertise, a lot of you, because you've spent time in India, you spend time in Asia. This is where the growth is. This is where the growth is. It's not in Europe, we've seen it. It's really not in the United States. It's in Asia. It's in Latin America. So build on it. Third is, form partnerships with local firms. I've spent a lot of time trying to develop markets in different countries, and it's very hard. Distribution is local. Manufacturing investments can be global, but distribution is local and service is local. So get your partnerships. Fourth is, get your financing commitments lined up now. You are living in the best era of interest rates that you will ever see in your life. There's only one way interest rates can go, and it's not down. If you start at zero, unlikely to go further down. Lastly, work with smaller financial institutions. Yes, there are lots of big players, but these big players are going to have much higher regulation. They're going to be really under the gun. And there are lots of gaps now. The demise of people like Bear Stearns and Lehman Brothers leaves lots of new opportunities for people. So take advantage of those. Thank you very much. I think, do we have time for just a few questions? Anyone? Yes, sir.
Yes, I agree with what you say. In China, though, there's very few investment opportunities for individuals. So two-thirds of all equity.
We got to have a question here.
Yeah, the question, two-thirds of all equity trades in China are done by individuals, but in the U.S., two-thirds of all public equity trades are done by high-speed computer algorithms. So how can you compare the stock market returns?
Well, the stock market return in China, the stock market is a very immature stock market. It's like the Taiwan market. It's like the Thailand market. They're basically gamblers, individual traders. There's nobody really holding for a long time. I don't think that you have any comparative advantage as a trader in China. There are lots of people there who have, let's face it, inside information, and you're not one of them. So the key in a place like China is to find a local partner, bring something new to the party, and try to start a real business. But I don't think it's in the publicly traded markets. Yes, sir.
Talk a little bit about what you think a bank size should be.
Well, I think, actually, here's the answer. In the legislation that's going through now, they say any bank that's over 50 billion becomes systemically risky, and then it's in big trouble. They can break you up, they can do this and this. But 50 billion is just a number. It's not the amount of size of your assets. It's what your leverage is. It's what your capital is to your, so at 50 billion, Northwest Mutual is over 50 billion. Is that a systemically risky institution? I don't think so. So we have a very unsophisticated view. There isn't a size issue. It's how, leverage is the single most important thing, and we were definitely over leveraged. And then it has to do with the activities and all sorts of things. So it's a sophisticated analysis. There is no automatic number. It's a myth. It's something like Congress likes to have a number, but it's really not true. Yes?
If you could impose your own regulations, would you impose uniform risk models?
If I could impose my own regulations, would I impose uniform risk models? I actually would come up with the revolutionary concept of subcategories. That is, we have various types of loans, mortgage loans, et cetera, and then we ought to find objective criteria for high risk, medium risk, and low risk, and have categories we can understand. So they would be uniform in the sense that they would have the same objective criteria, but they would be different from bank to bank. So you want to have risk-adjusted capital, but you have to have a system of risk adjustment that we can understand and apply in an objective manner. I think we have time for one more question before the important people come on. Yes?
Where do you foresee the value of dollar versus emerging market currencies, and how that can impact the investment story?
Yeah, okay, so it's a tough question. The dollar, we have a great privilege as a dollar, and I think it really comes down to this. The dollar will, you know, what are your choices? The dollar, the euro, or the yen? Yen is fundamentally a flawed currency because of the demographics and lots of lack of growth. We've seen that the euro is a flawed currency because there's a fundamental schizophrenia between the monetary side and the fiscal side. So, in my view, the dollar will remain for a while. And the only currency that can actually replace the dollar is the renminbi as a reserve. But that can't happen in the next 10 years. It can happen in 20 years. First, you got to have a convertible currency before you do that. And we've heard things like SDRs, but they don't really work. So essentially by default, the dollar stays, and it will fluctuate back and forth. And anyone who can predict in advance which way currency values are going shouldn't be working.
Bob, I think we can do two more questions. I think
Two more questions.
Just two more.
Okay.
Two last questions.
Let's see. Yes, sir.
What do you think a Basel framework, regulatory framework, looks for the non-bank credit market?
Okay. What about for the non-bank credit market? Well, I think non-banks are going to be divided into two categories. The non-banks that get really big are going to be treated like banks. And basically, they're going to be over-regulated with lots of capital. But there are lots of non-banks that are going to proliferate and are going to do similar things. And that's actually, you know, going to be a tremendous growth sector. The key to non-banks is securitization. They don't have the capital base to make a lot of loans and hold on to them. They need to sell them in the secondary market. So as again, I'm preaching over and over again, we need to get securitization going. What does that mean? We need to make sure that everybody in the process has skin in the game. We need to have better credit rating agencies. We need to have more transparent structures. When I was in China, they said, well, we want to start securitization. I said, great, you can come to the US and learn everything not to do in securitization. We will teach you everything not to do. So that's unfortunate.
Last question.
Last question. Yes, sir.
What do you think of the fact that Congress and FASB suspended mark-to-market last year, and do you think they should be bringing it back?
Okay, well, this is a question about FASB and mark-to-market. I wrote a whole chapter on this in chapter 12, but basically, we have two different audiences. Investors want mark-to-market. They want to know what your best current estimate is of the value of a security. But we know that markets fluctuate a lot. So we can have unrealized gains or unrealized losses that are significant. But there's a second audience, and that's the bank regulators. And they determine whether a bank is solvent or not. So we have to decide, are we going to say that just because the investors get bonds marked to market, if there's an unrealized loss, we're going to declare the bank insolvent? That's what these bankers are really worried about. So I have two suggestions. One is we should unlink accounting requirements from bank capital requirements. We don't have to have the same time frame. We don't have to have the same rules. We could be forthcoming about what market values are, but bank regulators don't have to say, just because you're showing this big loss for the quarter, you're insolvent. They don't have to do that. The second thing, and this is a more radical suggestion, is I believe that every public company should put out 2 earnings per share, one with fair market value and one without, because that will start to educate investors and also will give management a chance to explain that there is a core stream of earnings in most financial institutions, and then there is a fluctuation, currency, bond markets, et cetera. And we really need to separate those 2 streams because they really are very, very different. And if we can do that, we can sort of reconcile this. Otherwise, people are just going to fight for lots of years on this. Thank you very much.